Welcome, and thank you so much for joining us. We really appreciate you being here. And if you get value from what we do, turning these really complex documents into something clear and actionable, do us a quick favor. Please hit that like button, share this with someone you think should hear it, and of course, subscribe so you don't miss our next one.
So today we're opening up the books on a company that has, truly changed how we travel, Airbnb, ticker symbol ABNB. We're looking at their quarterly report, the Form 10Q, for the 3 months that ended September 30, 2025.
Right, so that's Q3, their absolute busiest season.
The peak travel season, exactly.
And our mission for you is, well, it's pretty straightforward. We've gone through this really dense legal and financial filing, and we're going to pull out the critical information you actually need, focusing on two big things. First, the operational engine. Is it still humming? And second, the structural and regulatory headwinds that are starting to show up on the bottom line.
Yeah, and to really get Airbnb, you can't start with revenue. You have to start with the operational engine first, because the volume and the pricing, that's what determines every single dollar that eventually hits the income statement. So we're talking about nights and seats booked and how that turns into gross booking value, or GBV.
Okay, so let's unpack that engine then. Q3 is where every travel company should be shining. What kind of volume did Airbnb actually push through?
The volume was solid. I'd say, solid, maybe a little bit moderated compared to past years. Nights and seats booked, that's all the stays and experiences. It increased 9% year over year.
9%.
To 134 million. That's pretty steady growth in what's becoming a very mature global market.
Okay, 9% volume growth.
Mm-hmm.
But the actual value of those bookings, the GBV, that's where you see the pricing
Yeah.
power, right? How did that look?
Well, that's the interesting part. GBV soared 14% year over year, hitting almost $23 billion. And this is the key thing for you to notice. The volume of nights grew 9%, but the dollar value of those bookings grew 14%.
So there's a 5-point gap.
Exactly. That gap tells us one thing very clearly. The average daily rate, the ADR, went up this quarter quite a bit.
So people are paying more per night, or maybe they're booking more expensive places, longer stays, that sort of thing.
That's right. The platform is definitely getting more value out of each booking. It's a sign of real pricing leverage.
Okay, so where is this growth actually coming from? Historically, it's been North America and Europe, right?
It has, and they're still the biggest markets in dollar terms. But the report makes it very clear that the acceleration, the real forward momentum, is coming from other places.
Interesting.
Growth was seen across all regions, but the strongest percentage growth was in Latin America and the Asia-Pacific region.
That feels like a critical insight. If the West is maturing, the next big wave has to come from LATAM and APAC.
It does, and that's a double-edged sword. The opportunity is massive scale. Huge populations, lower market penetration.
But the risk?
The risk is that these markets often have lower ADRs and, maybe more importantly, really complex and new regulatory hurdles that are less predictable than in Europe.
Got it. So they're chasing growth, but they're also accepting more friction to get it.
That's a great way to put it.
Okay, so let's connect all that to the top line. How did revenue land for Q3?
Revenue grew 10% year over year. It hit just over $4 billion. And it was driven by exactly what we just talked about, more check-ins and that nice little bump from higher average daily rates.
What about currency? Sometimes international growth can look a little skewed because of exchange rates.
Great question, and a really important one. The report notes the constant currency revenue growth was also 10%.
Oh, okay. So no help from the dollar.
None.
Yeah.
That 10% was pure operationally driven growth.
Perfect. So the operational story is strong. Now let's pivot to the financials. We're going to give you that mandated snapshot of the core results for Q3 2025 compared to the same time last year.
All right, let's lay out the key figures for you. Revenue, $4.095 billion versus $3.732 billion last year. That's your 10% growth. Net income, $1.374 billion versus $1.368 billion. That's an increase of only $6 million. Basically flat.
Wow.
Diluted earnings per share, or EPS, $2.21, up from $2.13. Net income margin, this is a big one. It dropped to 34% from 37% last year.
Margin compression.
And finally, adjusted EBITDA, $2.051 billion, with the margin there also slipping a bit from 52% down to 50%.
Okay, that margin compression really jumps out. You just said revenue grew a healthy 10%, but the net income, the actual profit, was completely flat. Up only $6 million. That 3% drop in net income margin, It tells us something is eating up all that new money, right?
It is the central mystery of this entire report. It signals that for every new dollar of revenue, their costs are rising even faster. Something big happened this quarter that completely absorbed all of that operational success.
Exactly. And we need to solve that mystery. This is where we get into the 5 critical takeaways that explain what happened.
Let's start with takeaway number 1, which is sort of the high-level explanation. The report says revenue growth was largely offset by 3 things: more payroll expenses, lower interest income on their cash, and a huge increase in their income tax provision.
Okay, that tax provision sounds like the smoking gun. And that brings us to takeaway number 2. This feels like the biggest distortion in the whole report.
It was a massive non-cash drag on the quarter. The main reason for the flat profit was a $213 million valuation allowance.
The valuation allowance.
Right, recorded against their deferred tax assets. Specifically, corporate alternative minimum tax credits, or CAMT credits.
Okay, break that down for us. What is a $213 million write-off, and what on earth triggered it?
So think of it like this. They had a big valuable coupon for future tax savings, these CAMT credits. But then new legislation came along and basically made that coupon expire immediately.
And that legislation was?
The report names it specifically. The One Big Beautiful Bill Act, or OBBBA, signed into law in July 2025.
The OBBBA.
Yes, and because of that law, management concluded it was no longer more likely than not that they could actually use these tax credits.
So they had to write them off.
They were forced to, under accounting rules. So that $213 million non-cash expense is the single biggest reason net income looks so weak compared to revenue. It completely masks the underlying story.
That's essential context. A legislative change just wiped out $250 million in value on paper, but they also chose to spend more. Let's get to takeaway 3, the big jump in spending on product and marketing.
Oh, for sure. Costs are definitely rising because they are investing. Sales and marketing expense jumped 24% year over year.
24%, that's huge.
It is. It hit $639 million, driven by marketing for a specific product launch and, of course, higher payroll.
Is that a sign that it's just getting more expensive to find new hosts and guests as they get bigger?
That's the tension, right? It's hard to say from one quarter, but it certainly suggests the cost of acquisition is going up.
And where else are they putting money to work?
Product development. That expense grew 12% to $587 million, and that's mostly from hiring more engineers, developers. They're bulking up the team.
So you combine those, and that's well over $1 billion in just one quarter on product and marketing alone.
A massive investment.
Okay, so we have the big tax hit, we have the strategic spending. Now for takeaway 4, which feels less voluntary. This is the regulatory cloud that just seems to follow this company everywhere.
This is, I think, the biggest long-term risk to their profit margins. The regulatory pressure is just getting more intense, and the cost to comply is staggering. We saw it this quarter with these huge settlements with the Italian Revenue Agency.
Right, I saw that.
Yeah.
How big was the Italy settlement exactly?
It required payments totaling 967 million euro.
Wait, euro.
So that's almost $1 billion US, give or take, just to settle tax disputes in one country for the past few years.
That is just an astonishing number. Is this now just a recurring cost of doing business for them? Fines in the hundreds of millions?
The evidence really points that way. It's a structural cost of their business model. And it wasn't just Italy. In Spain, they got a proposed fine initially for 110 million euro, which was later reduced to 65 million.
And they're fighting that one.
They're fighting it, but it just shows this constant stream of legal liabilities. It's like a hidden tax on their whole operation.
Okay, that explains where the 10% revenue growth went. But let's get to the good news. Takeaway number 5. Despite all this noise, the company is still an incredible cash machine.
It really is. Free cash flow for the quarter grew significantly to $1.349 billion.
$1.3 billion in cash in one quarter.
With a free cash flow margin of 33%. It just proves that the underlying machine is working incredibly well, even if the net income line is messy.
And it seems like management is using that cash to signal a lot of confidence.
Absolutely. They are aggressively returning it to shareholders. They bought back $857 million worth of stock in Q3 alone.
And the authorization is even bigger?
Much bigger. They now have $6.6 billion left on their current share repurchase programs.
So they're betting on themselves. They see all this regulatory noise. They see the tax hit, and they're thinking the stock is cheap.
It's hard to read that $6.6 billion number any other way. They're signaling that they think their future cash flow can easily handle these headwinds.
That's a very strong signal indeed. Before we wrap, let's just touch on their balance sheet and future plans. They must have a huge pile of cash.
They do. Liquidity is very strong. Cash equivalents, short-term investments, it all totals $11.7 billion. They're extremely well capitalized.
And they're using that capital to lock in some massive future expenses. I saw two big new contracts signed in June.
That's right. The first one is a huge investment in their core tech, a new cloud hosting agreement. It totals at least $1.9 billion over a 6-year term.
1.9 billion just for cloud hosting.
It shows you the immense scale and cost required to run a global platform like this, especially if they're adding things like AI tools.
That's a massive fixed cost for the next decade. What was the second commitment?
It was smaller, but still interesting. A 3-year sponsorship agreement for at least $55 million.
So still investing heavily in that big brand marketing.
They are. It suggests they still feel the need for major brand visibility, even at their size.
So let's bring it all together for you. The Q3 story for Airbnb is this classic study in contrast. On one hand, you have incredibly strong operational momentum, 10% revenue growth, huge international expansion, and massive cash flow of $1.3 billion.
But that success was almost completely invisible on the income statement. It was obscured by that one-time non-cash tax hit of $213 million. And these mounting continuous costs from legal settlements in places like Italy and Spain.
So if you connect this to the bigger picture, what's the ultimate challenge for Airbnb going forward?
I think the challenge is fundamentally political friction. The demand is there. That's not the problem. The problem is the increasing friction with governments all over the world. These massive legal settlements and compliance costs, they act like a permanent systemic tax on the business model.
And that leads us to a final provocative thought for you to keep an eye on. The 10Q mentions a major, still unresolved IRS audit. It's about how they valued their international intellectual property way back in 2013.
And that audit carries a potential liability of $1.3 billion, plus penalties, plus interest.
A potential billion-dollar liability just sitting out there?
Yeah. Considering they just took a $200 million tax hit this quarter, how that $1.3 billion dispute eventually gets resolved, that is probably the single biggest financial question mark hanging over this company for the next few years.
A powerful note to end on. A billion-dollar sword hanging over an otherwise very successful company. Thank you so much for walking us through that. Incredibly helpful. And for all of you, we hope this dive gave you the clarity and insights you were looking for. If you enjoyed it, please click like, share this video, and definitely subscribe for our upcoming content. We'll see you next time.